So we're now well into earnings season. We're starting to hear from some of our real estate investment trusts that we like to cover. And EPR Properties has been an interesting case lately. It started off 2022 as one of our best performers. While the market really started to take a decline in early 2022, EPR was holding up really, really well. That was until one of its largest tenants, Regal Entertainment, or its parent company, decided to declare bankruptcy. The movie theater business has been struggling for a little while, and the COVID pandemic was just kind of a real, a kick while it was down, if you will. So Regal just is going through bankruptcy proceedings right now, and that kind of sent the stock plunging, and it hasn't really recovered since. So we just got to look at the first quarter earnings, and so far the numbers look fairly good. EPR's revenue grew by almost 9% despite not having much of a growth in the portfolio. So that was mostly just organic revenue growth. Um, Funds from operations, FFO, grew by 12% year over year. The company is making more than enough to cover its dividend. It generated about $1.30 per share in FFO this quarter, and it paid out about 83 cents per share. So its dividend is well covered, even though it has roughly an 8% yield right now. Investment spending has slowed down somewhat. That's to be expected in a rising rate environment like we're in right now. But the company is still making some strategic investments. They bought a health and wellness property this quarter. They've committed to about $250 million of future spending, and they're planning to fund that without having to take on more debt or to raise capital. That's just going to be the excess cash they're generating after paying out dividends, which is a nice luxury to have for a REIT. That's not a big needle moving number of acquisitions, but it's something. They have, and here's kind of where investors need to start paying attention. And I know Tyler probably has some thoughts on this. EPR often, kind of uses its liquidity position as a positive. It's got almost $100 million of cash on the balance sheet, and it has a $1 billion untapped credit line. The kind of caveat with that, if it were to use that $1 billion credit line, it would be in violation of its debt covenants. So really, yes, it's there, but it can't really use it to the extent that it sounds like. It couldn't go buy a property for $1 billion right now and put it on that credit line. One, that's a variable rate credit line, so that would just be a bad idea. And two, we would put it in violation of some of its debt rules. And finally, Regal has been paying rent. Regal paid rent through April, which was a very nice part of the report, but is still engaged in bankruptcy proceedings and negotiations with EPR on its leases. And it's expected to come out of that process mid-year, so we'll have to see what happens.
Yeah, the one thing actually that was most encouraging for me was the fact that, like you just said, management was looking to add to the portfolio without tapping, external capital. If you with a dividend yield that high and a debt where it is, not a great time to be expanding. And like you just said, don't want to get in violation of debt covenants, obviously. So to be able to pick your spots, I think is something that I'm encouraged at, because previously, they set some ambitious plans for growth, but now like reining that in, that actually is encouraging to me to see them kind of tap the brakes and play within the sandbox they can play in.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.